Okay, hey everyone, and a big welcome to all you Stock Talk podcast listeners tuning in.
Great to be here.
Today, we are jumping straight into some really interesting source material. We're looking at the recent Q1 fiscal year 2026 results for Marvell Technology.
That's right. We've been digging into their earnings report, the financial analysis that came with it, and, key bits from their 8K filing covers performance right up to May 29th, 2025.
And our mission really is just to unpack these results quickly, get a handle on the key drivers, what's behind Marvell's performance this quarter, and just zero in on what really stands out from all this information they've put out.
Yeah.
Especially, I think, for anyone tracking tech and specifically AI infrastructure. This is, well, it's a big one.
Absolutely. Essential, really. So looking at the overall Q1 performance, the headline numbers are, well, remarkably strong.
They really jump off the page, don't they?
Yeah.
We're seeing record net revenue hitting $1.895 billion.
Which is a huge number in itself.
Exactly. But the year-over-year growth, I mean, that tells an even bigger story.
A stunning acceleration, 63% increase compared to Q1 last year.
Wow.
And it's worth noting this actually came in $20 million above their own guidance midpoint.
Right. Always a good sign when they beat their own forecast. What does this level of growth tell us about their market right now, based on the material?
Well, it points very clearly to one dominant force. Just exceptional demand for AI infrastructure. That's flagged as the primary engine here, no question.
Yeah, that AI tailwind is loud and clear. Okay, turning to profitability. GAAP diluted EPS, 0.20 cents. Non-GAAP diluted EPS are 62 cents.
And that non-GAAP figure, 62 cents, it's really telling. It surged 158% year over year.
158%.
Yeah, from $0.24. So that kind of leverage, it indicates a really significant chunk of that massive revenue increase is dropping to the bottom line.
And they're generating cash, too. Operating cash flow came in at $332.9 million.
Solid cash generation. So yeah, strong top line, translating into really strong non-GAAP profit and healthy cash.
But to really understand where this is coming from,
yeah,
we need to look at the segments, right?
Exactly. And all the signs, all the data points squarely at the data center segment. That was the powerhouse this quarter.
No kidding. Data center revenue reached $1.44 billion.
Just massive.
And the year-over-year growth for just that segment, an incredible 76%.
A huge leap, yeah. And it highlights how dominant it's becoming in their overall mix. It's now 76% of total revenue.
Up from 70% last year.
Right. So, the data center story really is the Marvell story this quarter.
So what specifically within data center is driving this? Based on what they've laid out?
Two main things are highlighted. First, the rapid scaling of their custom silicon programs.
Okay, so designing specific chips for the big cloud providers.
Precisely. And second, robust shipments of their electro-optics products.
Got it. Those are the high-speed connectors, right? Essential for linking everything up in AI clusters.
Exactly right. Fundamental building blocks for these huge AI data centers. And the material connects this directly to Marvell's position, sort of right at the center of this whole AI infrastructure transformation that's happening.
And it sounds like they're really pushing this angle. They mentioned an upcoming custom AI investor event.
Yeah, June 17th, 2025. They specifically say it's where they'll do a deep dive into their AI platform and, crucially, this custom silicon opportunity.
Okay.
And there's a quote from the CEO, Matt Murphy, that really sums it up. As the industry continues to move toward building custom AI infrastructure, Marvell is uniquely positioned at the center of this transformation. We see our custom silicon business driving strong growth in the second quarter and beyond.
Uniquely positioned. That's strong language. So the strategy here seems to be that the hyperscalers, the biggest customers, they want tailored solutions now. And Marvell is aiming to be the partner for building those custom chips.
That definitely seems to be the core strategy coming through here. It's a shift, from just standard parts towards these really deep, customized partnerships.
Okay. Now, data center is clearly dominant, but let's get the full picture. How did the other segments perform, according to the documents?
Yeah, they provide important diversification. Actually, carrier infrastructure showed really exceptional growth, too, up 93% year over year.
93%. Wow. Outside of the main AI driver, what's behind that?
Well, it's attributed to strong demand for optical transport systems and also broadband access gear.
Ah, so ongoing network upgrades.
Exactly. Infrastructure modernization plus the bandwidth demands that things like AI and edge computing are creating.
Makes sense. Okay, enterprise networking.
Solid growth there, too, up 16% year over year, hitting $177.5 million. That's about 9% of their total revenue.
And the drivers there.
campus Ethernet switching, network appliances, supporting things like hybrid work, and just generally more data moving around inside businesses.
Okay. What about the consumer market?
Strong percentage growth again, 50% year over year, but it's smaller, $63.1 million, driven by gaming consoles, home networking.
Right. 50% sounds great, but as a piece of the total.
Yeah, it's only about 3% of total revenue now, which kind of underscores how much their strategic focus has really shifted towards these bigger infrastructure plays.
Got it. And finally, automotive and industrial.
That one saw a slight dip, modest 2% decline to $75.7 million, about 5% of total revenue.
Mixed results within that segment.
Yeah, seems so. Some softness mentioned in automotive, ADS, industrial Ethernet, but partly offset by growth in areas like military and government.
So maybe some cyclical stuff hitting there.
Seems likely, though the material still frames it as having, long-term potential with autonomous driving tech maturing down the line. But overall, these other segments, while smaller, still show some strength and provide that base.
Okay, good overview. Let's shift to profitability now, specifically margins. The numbers here are interesting. GAAP gross margin expanded nicely.
Yeah, up 480 basis points year over year to 50.3%. That reflects the leverage from higher volumes.
But the non-GAAP gross margin actually decreased, dropped 260 basis points to 59.8%.
Right.
So why the dip in the non-GAAP number when revenue is soaring and GAAP margin is improving? What do they say?
The main reason given is product mix. Simple as that, really. As those big custom silicon programs ramp up really fast, they currently have different margin profiles compared to, say, more mature standard products.
Ah, okay. So it's not that overall profitability is suffering, it's just that the fastest growing part has a different margin structure, at least initially.
Exactly. And the material presents this as a strategic trade-off. They're prioritizing grabbing market share in this huge AI growth area with these custom deals,
Right.
accepting a temporary impact on the non-GAAP gross margin number with the expectation that they can optimize that margin over time as these programs mature and scale.
Okay, that makes sense. Important context. Looking lower down, operating performance looked much better. GAAP operating income, $270.6 million. That's a big swing from a loss last year.
Huge turnaround. And the non-GAAP operating margin expanded impressively, too, climbed to 34.2% from 23.3%.
Clear operational leverage there.
Absolutely, because revenue is growing so much faster than operating expenses. GAAP OpEx was around $681.8 million, pretty flat, considering the revenue surge.
So that disciplined spending means more of the revenue growth falls to the bottom line.
Precisely. And you see it in the net income figures. GAAP net income was positive $177.9 million versus a loss before, and non-GAAP net income just surged, $540 million. That's a 161% year-over-year jump.
Wow. And they mentioned a favorable non-GAAP tax rate helping too.
Yeah, 10.0% for the quarter.
Yeah.
So, even with that non-GAAP gross margin dip due to mix, the overall operational leverage delivered really substantial profit growth.
Okay, shifting to the balance sheet and cash flow, how's the financial foundation looking based on the sources?
Well, the business is still generating good cash. $332.9 million in operating cash flow for Q1.
And we saw working capital increase, accounts receivable, inventory.
Yes, both up. Which you'd expect, right?
Yeah.
When sales and demand are growing this fast, you need more inventory on hand, and your receivables naturally go up.
And CapEx also increased, $118.8 million.
It did, and the material ties that directly to capacity expansion needed to support these high-demand AI products, investing to meet the growth.
What about capital allocation? What do they mention doing with their cash?
Key actions highlighted were repurchasing $340 million of their stock in the quarter.
Returning capital.
And maintaining their quarterly dividend payments, about $52 million total. They also mentioned continuing investment in key technology licensing.
So returning cash, but also investing heavily for the future. How does the balance sheet stack up overall?
At the end of Q1, they had about $886 million in cash. Total assets were just over $20 billion, though it's worth remembering a big chunk of that is goodwill and intangibles from past acquisitions.
Right.
Total debt stood at $4.23 billion, so the picture presented is definitely one of a solid financial foundation to support everything they're doing.
Okay, good to know. Now looking ahead, what's the forecast for Q2 fiscal 26?
Guidance points to continued strength. They're targeting revenue of $2.0 billion plus or minus 5%.
So hitting that $2 billion mark. Further sequential growth, and still very strong year over year.
Absolutely. And the driver, It's the same story. Continued robust demand from data center AI. They explicitly state those custom silicon programs are expected to keep scaling up and driving that sequential increase.
And the profitability outlook for Q2, margins,
Yeah.
OPS.
Gross margins guided pretty similar to Q1, 50% to 51% GAAP and 59% to 60% non-GAAP.
Look,
And the non-GAAP diluted EPS target is 0 and 67 cents plus or minus 0 and 5. So suggesting, continued strong profitability following these Q1 trends.
operating expenses projected to tick up a bit as well.
Yeah. Expected around $735 million GAAP and $495 million non-GAAP in Q2, a slight increase to support the growth.
So basically, the expectation is more of the same AI-driven growth powering the results. What gives management confidence in this outlook, according to the material?
They point to a few things. A robust design win pipeline suggesting future deals are lining up.
Yeah.
Existing multi-year partnerships with key customers, which gives them some revenue visibility. And just the fundamental, long-term secular growth trends driving AI infrastructure investment globally. They see themselves riding a powerful wave.
Okay, before we wrap this deep dive, let's just quickly summarize the key opportunities and risks that were highlighted in these sources. Opportunities first.
Sure. The opportunities listed are pretty significant. Obviously, the massive AI infrastructure market expansion itself. Then the potential for market share gains as the industry shifts more to custom solutions where they're focused. Those multi-year customer partnerships provide stability, their crucial role with electro-optics, the strength of their overall tech platform, and the potential for margin expansion over the longer term as these programs mature.
That's a compelling list of tailwinds.
Right.
Okay, what about the risks they call out?
On the flip side, several risks noted. Customer concentration relying heavily on a few very large hyperscalers.
Always a factor.
Yeah. The potential risk that those big customers could eventually decide to develop more capabilities internally, insourcing.
Right, doing it in-house.
Exactly. Then there's the general cyclical nature of the semiconductor industry. Execution risks actually delivering on these complex custom programs at scale. Supply chain dependencies, always a factor. And of course, intense competitive pressure.
Okay, those risks definitely provide important balance to the growth story.
They do. And just to reiterate, this whole analysis is based purely on the Q1 earnings release and the filing we've been discussing.
Right, sticking to the source material. So boiling it all down, synthesizing everything we've just walked through from these documents. What's the overall picture?
It's really a picture of exceptional Q1 performance, almost entirely fueled by data center demand for AI. Marvell is clearly positioned and positioning itself as a key player in AI infrastructure, specifically through that focus on custom silicon and electro-optics. The strategy seems clear. Scale those custom programs, even with some near-term margin trade-offs, and ride this wave. And the outlook suggests the momentum continues.
The key strengths that jump out are that record growth, the leadership position in these key AI technologies, the operational leverage driving profits, the solid financials, and that broad tech platform.
And their strategic focus areas seem crystal clear. Scaling custom silicon, grabbing AI market share, optimizing margins down the road, managing those risks we mentioned, and just staying ahead technologically.
It really paints a picture of a company deeply embedded with the giants building out the future of AI, which brings us to maybe a final thought for you, the listener, to ponder based on all this. Given Marvell's intense focus on these custom silicon deals with just a few massive hyperscale customers, and also considering that risk we mentioned, the potential for those same customers to eventually bring more capability in-house over the long term, how do you think Marvell's strategy navigates that balance? The balance between being this essential, deeply integrated partner today,
Right.
and the potential challenge of customer insourcing maybe years down the road?
Yeah, it's a fundamental strategic tightrope, isn't it? For any company so closely tied to the tech titans. Something to think about.
Definitely something to think about. And that wraps up our deep dive into Marvell Technology's Q1 fiscal 2026 results, based strictly on the sources provided.
Hopefully this gave you a good, concise understanding of the key takeaways from that material.
Absolutely. Thanks for joining us for this deep dive.